Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg. After a widely awaited set of data releases, we had the inflation numbers released yesterday for India as well as US. The Indian inflation eased to 5.66% in March from a 6.44% in Feb. Even the core inflation for Indian economy eased to an 8-month low, well within the RBI's mandated band. But simultaneously, we had the US inflation numbers, and although the headline inflation showed easing, but the core inflation remains on the higher side. And this led to some short term yields tumbling a little, but the market participants continue to lean towards one more hike before any pause. So, JK, what do you think of this inflation numbers and the FOMC minutes released yesterday?
Yeah, good morning. So on the face of it, we had very good news all around yesterday, and CPI drop was a welcome news. But the details are slightly not so comforting. I would say it was kind of mixed. The headline number was lower than expected because it had a big base effect help as well. But the worrying part was the year-on-year core inflation, which remained at 5.6% and way higher than what Fed would want to see it at. Then the good news was that rental inflation was increasing at a much lower pace than it was in the earlier months, and house prices were also dropping. And then the FOMC minutes, again, the good part was that they considered whether they should pass because of the banking related problems. But eventually, looking at the inflation, which remained sticky, they had decided to hike. But at the same time, the statements showed that they were quite uncertain about the impact of the banking related crisis on the economy. So that was really what the market took as indicating that there could be more troubles, or there could be more impact, a negative impact on the economy. That really showed up in the stock prices, which really did not hold on to the gains that came about in the futures market, and then it was even in the green for most part of the session after the CPI data as well. In fact, for the first time, we also saw a few Fed members turning quite cautiously dovish. Feds, Mary Daly noted the possibility that inflation may be able to slow enough to accomplish a return to target without more tightening. And then John Williams, the New York Fed president, said that one more hike followed by a pause was a very reasonable starting place for debate as they approach the May 2nd meeting. However, in the light of the heightened uncertainty and emphasis on flexibility, the March minutes actually offered very little guidance on the policy outlook going forward. So in the end, market has still been discounting a 0.25% hike with a probability at 62%, slightly lower than 70% was there earlier. But again, towards the end of the year, the futures do show cut in the rates. Now, so the impact on the yields was also somewhat retraced later, but it definitely ended lower, not as much as one would have liked to see. Then the stocks were obviously in the negative. I think concerns about the economy is more telling on the sentiment. On the currencies, dollar has fallen more across the board, and mostly held on to the lower side. The impact was more because of the Eurozone officials once again indicating that more rate hikes are needed in the Eurozone by the ECB. And the indications are that there can be another 0.75 hike which may be left for the ECB to accomplish. That would put the ECB rate almost closer to where the US rates are. And that's why the euro currency has been quite outperforming against the dollar. And of course, the fall in the yields is also having some impact on the USDN, which went below 133, but again bounced back above 133. We are closing in on the first meeting, which will be chaired by the new Governor Ueda, and so far his comments have been dovish. But market never gives, the yen bulls never give up actually. They think that there will be sudden move and then can be a big yen strength. So we're having moved up from 129 to 134. We are seeing some selling in the USD. So overall, there is a downward impact on the dollar, which is been maintained. And we will have more evidence of the US inflation today when PPI inflation data is released. And today, then we had the Bank of Canada, which continued to maintain the rates at 4.5 for the second successive month, although they indicated that they are ready to act if the inflation were to start to rise again once again. Australian employment report was another positive news for the market. So overall, this sentiment is still on a mixed side. Not seeing much of an impact on the stock market from the lower CPI number. I think more focus is on how the economies are going to perform due to the hefty rate increases that the central banks have done. So far, let's also note that so far not a single bank has actually cut the rate, and it's all in rooting at the highs as of now. On the Indian side, CPI definitely a welcome drop. Below 6%, 5.66% versus 6.44 in February. And the good news is that food inflation basket, which has weightage of 54.18% in the overall CPI, was lower at 4.79 versus 5.95% in February. It was at 7.68% a year ago. The cereal prices, which had been the biggest contributor to the food inflation for quite some time now, also recorded its first month-on-month contraction in 21 months. So since January, and it has been helped by supply-side intervention by the government, which has been selling the cereals out of their, the buffer stocks. So the RBI move to pause rates in the last week's meeting seems to have been driven by possible initial indications on the inflation, which they would have definitely considered. Another good part of India's report was the declining services inflation, and the core inflation dropping to 5.78% from 6.05%, a 10-month low, much to the relief of the policymakers. With inflation now showing signs of topping and even global trend turning down towards a policy path, it's very likely that RBI might have come to the end of its tightening cycle, but maybe a bit early to say. We'll have to see more, indications on the inflation. But definitely a positive impact on the bonds should be seen, which has already dropped more than 10 basis points from the recent highs, and then likely to see more demand. But what we've also seen is a steady inflow of FII. FII funds into India in the last few weeks, and though not in a big chunk, but it is positive, and possibly the Indian improved macro picture may be just turning into real money flowing into India, but it's too early to say, as the global markets still seem to be in a very uncertain phase. We have a break again, long weekend starting tomorrow for the markets, and and in the meantime we will have more data to chew upon, and particularly we'll have big banks in US declaring their numbers, the Citi, JP Morgan, and the Wells Fargo. So we'll have a lot to digest when we return for trading on Monday. Meantime, we'll enjoy the long day. Thank you.
Okay, JK, quite good. And yes, folks, there has been a lot of data releases and a lot of analysis which is being done by the market participants. And like JK mentioned, although the headline numbers were quite good, the base effect was one of the reasons for the headline numbers to be this good. Other than that, the core inflation remains on the higher side. House prices have been declining. The rental income has been gradually increasing. So there is still some things that the Fed is considering before they go ahead with any sort of pause in their rate hike regime. And even the market participants are expecting a 62% probability of a hike. Whereas if we have to talk about hike, ECB looks quite certain on their part towards the rate hike, which has kept the currency movement in check. But another major central economy which is looking a bit on the dovish side by the central bank is the Japanese economy. The new incoming governor, Mr. Ueda, have been from his initial statements looking a bit on the dovish side. But all said and done, on the domestic front, it is the Indian Central Bank who were seen preempting the kind of action to be required from the initial inflation data, and the new improved macro picture does look like there is possibility of any real flows coming in. Basically, real flows have been one of the reasons why any appreciation for rupee has been stunted as of now, but let's see how things go in the future. Thank you so much for joining, folks, and as DK mentioned, it's a long weekend, so we shall come back again on Monday with another round of updates. Thank you so much for listening.